to Iron Financial, where we forge stronger portfolios by cutting right through the market noise. Today, a true titan is on the anvil, Blackstone. They just dropped their Q1 2026 earnings, and the headline numbers, well, they're absolutely colossal. But here's the thing. When you look past those big, flashy headlines and really start digging into the blueprints, the story gets a whole lot more complicated. So today, we're putting Blackstone to the ultimate stress test. Is this thing a fortress for your portfolio, or is it a facade that's just waiting to crumble? Okay, let's just get straight to it, because this is the whole puzzle right here. These numbers create a massive paradox. On one hand, you've got revenue of $3.62 billion. Now, this didn't just meet Wall Street's expectations, it absolutely obliterated them, soaring almost 30% year over year. A huge beat. But then, you flip the coin. You look at their GAAP profit, that's the real by-the-book number, and it came in at a measly 83 cents per share. The street was expecting $1.32. I mean, that is a jaw-dropping 37% miss. So the question is immediate and it's obvious. Is that huge, shiny revenue number just a smokescreen? Is it masking a fundamental problem with actually making money? That is the critical question, and it's exactly what we're here to break down. But look, before we start grabbing our sledgehammers and looking for cracks in the foundation, we have to respect the sheer scale of the structure we're even analyzing. So let's start by building the case for Blackstone as this impenetrable financial fortress, and we'll begin with the raw, just overwhelming power of their numbers. This is the number, right here. This is the bedrock of the entire bull case. $1.3 trillion in assets under management. You really have to let that sink in for a second. This isn't just some big number on a slide. It's a statement of near absolute market dominance. What you're looking at is a global, capital-attracting machine of a size and a scope that almost no one on the planet can even come close to challenging. In the world of finance, this is a moat literally built out of solid gold. And that moat? It isn't stagnant. It's actively getting wider and deeper every single day. In what their own management called a turbulent first quarter, Blackstone pulled in $68.5 billion in fresh capital. These are new inflows, new money. While smaller firms are out there fighting for scraps, Blackstone is still the #1 destination for the world's largest pools of money. We're talking sovereign wealth funds, massive pension plans. Capital is still flowing, and it is flowing directly to them. That is a powerful, powerful sign of immense trust and deep structural strength. Now look at the numbers on this slide. What you're seeing here is the sheer acceleration, nearly 30% year-over-year revenue growth. They jumped from $2.76 billion a year ago all the way up to $3.62 billion this quarter. This is not a company that's just treading water. This is a battleship picking up speed. They didn't just squeak by Wall Street's revenue estimates, they blew past them by almost 6%. That is raw top-line power in action. And this right here, this slide brilliantly illustrates the quality of that revenue. This isn't just about volatile, one-time performance fees they get from selling off an asset. No. These are their fee-related earnings. Think of it as the steady, recurring, almost utility-like revenue they collect just for managing all that capital. It was up 23% to $1.55 billion. This is the engine room of the fortress. It's predictable, it's growing, and it provides this thick, solid foundation of cash flow, no matter how crazy the markets get. And hey, you don't have to take my word for it. The man at the top, Chairman and CEO Stephen Schwarzman himself, he described the quarter as outstanding. He's pointing directly to those massive inflows and the positive appreciation across his key strategies as proof of concept. Management is projecting absolute unwavering confidence. From their vantage point, inside the boardroom, this fortress is standing strong and ready for anything. All right, that's a compelling case. A fortress, big numbers, the CEO's confidence, the battleship metaphor. It's a very powerful narrative, I'll give you that. But you know what? Massive structures can hide massive weaknesses. So it's time to stop admiring the architecture and start pressure testing the foundation for real. It's time to go looking for the cracks in this armor. Let's go right back to that glaring contradiction we started with, the elephant in the room. How does a company with surging revenue and record assets miss its profit target by over 37%? Wall Street expected $1.32 in earnings per share. They delivered 83 cents. That's not a small miss. It's not a rounding error. It is a crater. This is the first, and frankly, it's the biggest crack in the entire bull case. It points to a serious potential issue with the core profitability of the business itself. And I'm not the only one who sees it. Let's look at the ultimate judge, jury, and executioner, the market's verdict. Year to date, Blackstone stock is down almost 16%. Now, at the same time, the S&P 500, the broad market, is up over 4%. The market is screaming something here. It is telling you that for all the talk of a fortress, it's not buying the story. Big money investors are voting with their wallets, and right now they are walking away from the stock. The real question is, why? Well, this slide shows us exactly where the problem is. Look at the breakdown of their assets. Private equity, it's growing at a healthy 16%. Credit and insurance, even better, up 18%. All very solid. But then, you look at the big red flag, real estate. Over $300 billion in assets, and it's down 1.5% year over year. In this environment, with all the ongoing concerns about commercial real estate, this isn't just some minor crack. This is a foundational pillar of the company that is actively shrinking. And here's the crucial point. This isn't just a one-quarter problem. You have to zoom out. Blackstone's 5-year average AUM growth was a blistering 15.8% a year. But over the last 2 years, that growth rate has slowed down dramatically to 10.6%. The law of large numbers is an undefeated force in finance. So I have to ask, is this fortress simply getting too big to continue growing at its historical pace? Is the deceleration story the real story here? Okay, you've pointed out some serious, undeniable issues. The EPS miss, the stock's underperformance, and that clear slowdown in AUM growth pinpointed directly in the real estate segment. Those are legitimate data-backed concerns. I'm not going to argue with the numbers. So the time for high-level views is over. Let's pop the hood, get our hands dirty, and see exactly which parts of Blackstone's engine are firing on all cylinders and which ones are sputtering. This chart, this right here, tells the most important story of the entire quarter. We're looking at something called distributable earnings. Just think of this as the actual cash profit that can be paid out to shareholders, generated by each part of the business. The total was about $2 billion. Now look at that dark green slice, private equity. It generated nearly $1 billion of that total. That's almost half the entire company's profit coming from just one division. It's doing nearly double the work of the next closest segment. This is a high-performance V12 engine that is pulling the entire weight of the vehicle. But that raises a critical question about balance, doesn't it? Let's compare that earnings chart to this AUM donut chart. So, private equity makes up a third of the assets, but delivers almost half the profit. Incredible efficiency. But look at real estate again. It represents a quarter of the company's total assets, 24% of their entire book, and yet it's contributing a disproportionately tiny amount to the bottom line, and, as we just established, it's actually shrinking. Does that look like a healthy, balanced structure to you? To me, it looks like one engine is running red hot while another one is seizing up. That's a valid point on balance. But part of Blackstone's whole model is deploying capital when the time is right. And this number, this is their ultimate weapon. $213 billion in dry powder. This is undeployed capital, cash just sitting on the sidelines ready to be put to work. You should think of it as a massive arsenal. When markets get dislocated and high-quality assets go on sale, Blackstone has the firepower to go shopping while everyone else is running for cover. This is their ultimate offensive capability. Or is it a sign of weakness? You call it an arsenal. I ask if the generals are too afraid to actually use it. I mean, having a massive pile of cash is only a strength if you can deploy it effectively into high-return investments. Could this enormous dry powder figure actually be a signal that Blackstone, with its massive scale, is struggling to find attractive deals in the current market? Maybe valuations are too high, and they're just stuck holding billions in cash that's earning a dismally low return for their investors. It's a classic double-edged sword. You're right, it absolutely is a double-edged sword, and its value depends entirely on what happens next in the market. So let's bring all these threads together. We've examined the steel beams of the bull case, and we've pressure-tested the cracks in the bear case. Now, it's time to weigh all the evidence and draw up the final blueprint for investors. Any final analysis has to start right here, the corporate balance sheet. This is the bedrock. $11.4 billion in cash in corporate treasury, a sterling A+ credit rating from both S&P and Fitch. This isn't speculation. This is a fortress-grade financial foundation right now. Whatever cyclical pressures they're facing, this balance sheet ensures they have the strength and the stability to withstand them. They have the resources to navigate almost any environment imaginable. A strong foundation, I'll grant you that. But is it a good investment at today's price? This third-party scorecard from Smart Karma gives us a pretty objective view. It confirms your point on resilience, a strong 4 out of 5. It also sees the growth potential, another 4. But look at the value score, a 2 out of 5. The market already knows Blackstone is a high-quality company, and it is not on sale. You are paying a premium for that resilience, and by this metric, the stock just isn't cheap. And to add another layer of caution, look at Zacks Equity Research. They have a quantitative rating system that has a very impressive track record. And right now, they have Blackstone pegged as a Zacks rank number 4. In their system, that is an unambiguous sell rating. They're explicitly telling investors that based on unfavorable trends and earnings estimates, they expect this stock to underperform the broader market in the near term. That is a direct, data-driven warning signal you can't ignore. Okay, let's bring it all home. Here is the final iron financial verdict. First, this company is a financial fortress. The immense scale, the trillion-dollar AUM, the massive dry powder, and that powerhouse private equity engine. It's all absolutely best in class. But that fortress has a clear structural weakness. The real estate segment is a significant drag. Overall AUM growth is decelerating, and that 37% profit miss simply cannot be ignored. Which brings us to our final conclusion. Blackstone is not a simple buy or sell. It's a foundational, long-term holding that is currently facing significant cyclical pressure. If your time horizon is the next 6 months, that Zacks sell rating is a very serious warning. But if your horizon is the next 10 years, that A-plus balance sheet and trillion-dollar moat are the kind of bedrock you build a portfolio on. So that leaves us with the ultimate question for you to consider. Is Blackstone's colossal trillion-dollar scale a permanent competitive advantage? A true fortress that simply cannot be breached? Or is that very scale now becoming a weakness, a source of inertia, making this giant too big and too slow to pivot in a market that is changing faster than ever before? The answer will determine the next decade for this stock and for the investors who own it. Thanks for watching.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.